Okay, so reading 53, question 1, securitization benefits financial markets by C, allowing investors to tailor credit risk and interest rate risk exposures to meet their individual needs. Okay, next question. A special purpose entity issues asset-backed securities in the following structure. Okay, you get senior and two different subordinates. At which of the following amounts of default in par value would bond class A experience a loss? C. Okay, let me explain why. First 10 default, bond C gets kicked out. Then the next 300, but remember now it's 10, so 310, bond B and C are out. As soon as it gets over 310, class A or bond A will start feeling the default hitting them. Okay, so first 10 C, the next 300 B's out, and only after 310 bond A will feel it, but it has to be over 310. Does everyone understand? Cool. Okay, if a mortgage borrower makes payments with prepayments without penalty to take advantage of falling interest rates, the lender will most likely experience contraction risk. Okay, yield maintenance is obviously a penalty, and extension risk is the opposite. Okay, question 4. Antonio Jorge obtains a 6 million euro mortgage loan from Bank Danske. A year later, the principal on the loan is 5 million euros, and George defaults on the loan. Okay, Bank Danske forecloses, sells the property for 2.5 million euros, and is entitled to collect the 2.5 million euro shortfall from George. George most likely had a recourse loan. Okay, what does that mean, guys? If you default, you still have to pay back. Okay, so we'll see next is a non-recourse loan. Okay, does anyone want me to draw a picture on how to do this, or is everyone happy with it? Cool. Okay, so the next one is a non-recourse loan. So what would the answer be? 0. So Fran defaults. The bank says, okay, well, we're just going to take your house. They get, how much did they sell? 315,000. Unfortunately, the bank has lost out on the rest. Okay, Fran won't have to pay anything back. Okay, question 6. With regard to pass-through mortgage securities, which of the below describes a risk that will likely rise as interest rates rise? Extension risk. Okay, everyone happy? Okay, question 7. The balloon risk in a commercial mortgage-backed security transactions most likely represent a type of, it's actually extension risk. Okay, so guys, if in balloon risk with the CMBS, if you can't pay that lump sum at the end, you and the guy are going to have a chat and probably work something out to ensure eventual payments. So what are you doing? You pushing out the payments. Okay, it is a type of credit risk, but extension risk is the more right answer. Okay, so extension risk for balloon risk. Okay, if you can't pay at the end, what are they going to do? They're going to adjust the terms and conditions of the actual original agreement and come up with some new type of payment system. Okay, in a securitization, the originator of the loans is most likely referred to as the, I knew you guys were going to say that, but it's the seller. Okay, so guys, remember, there's little people here who want mortgages. The bank originates those. Okay, and what do? They sell those loans to the SPV, who then issues them to investors. Okay, so the SPV is the issuer, and the bank is the seller. Okay, trick question. Okay, support tranches are most appropriate for investors who are cool. Awesome, guys. You guys are killing this one. Okay, so remember, this is the support tranche. They get kicked out first, so what do they want? They want higher returns. Okay, little definition in the last question. The SMM most likely refers to the B. Okay, the amount of prepayment for a month as a percentage of the mortgage balance that was available to be prepaid that month. Okay, that's the definition of an SMM. You guys sounded like you really did well in this reading, so fantastic. Okay, second most important reading. Okay, reading 54. So question 1, consider a bond priced at 850. Okay, with a yield to maturity of 8%. Okay, semi-annual coupons, 6%. Modified duration is 10.75. Using the bond's duration, what is the expected decrease in price if the yield maturity increases to 9%? Yep, it's okay. Doesn't really matter, we don't need that. What did you guys get? Okay, so what's the formula? Okay, so guys, this means approximate percentage change in price, because I don't really have enough space, so that's what it means, is equal to minus modified duration times the change in y. Okay, so do you guys see how they trick you by giving you so much and you don't even need any of that, okay, apart from the change. So what did they say our modified duration is? Minus 10.75 times. Guys, it's an increase. So what happens when bond prices increase? Oh, sorry, when bond yields increase, bond prices decrease. So we know that A is out. Okay. Yeah. If they don't say decrease. Okay, times what is the change? 1%. So what do you get? Minus 10.75. But what did they want? They wanted the change in price. Yes, so then you times it by 850. And that is equal to minus 91.38. Okay, everyone happy? Okay, you guys should know this one now. A fixed income analyst makes 3 statements about duration. Which of the below statements concerning the interest rate risk is least correct? The answer is A. Okay, it's the larger the bond's duration. Okay, let me show you guys something I made. Okay, so we're talking about duration. And we're talking, the example I'm giving is an increase in duration. Okay, so they're always going to ask you either maturity, or they're going to ask you yield, or they're going to ask you coupon, or what's the last one? Zero coupon. Okay, let me start with the easiest. Zero coupon. Okay, what do you think duration and maturity? They're going to be equal because there's no coupons. So, duration here, to increase duration, what do you think maturity has to increase or decrease? Because of an increase in maturity. So when maturity increases, duration increases. Okay, increase in duration, what do you think has to happen to the yield? It's a decrease. So when yields decrease, duration increases. Okay, increase in duration. What do you think has to happen with the coupons? They have to decrease. Okay, so the way you can remember this is yields and coupons, they give you percentages. When they decrease, duration increases. Okay, maturity is positively related. So when maturity increases, duration increases. Think about duration as like time kind of thing. So if maturity is increasing, obviously duration will be increasing. Okay, and that is why answer 2 is A. Okay, guys, this next question you have to know. Okay, so a 5.25% 5-year annual pay corporate bond yielding 3.25% is priced at 108.541. If yields fall by 50 basis points to 2.75%, the bond's price will increase to 110. So what happened to the yield? It fell, so it's your V minus. If yields increase by 50 basis points to 3.75%, the price of the bond will fall to 106.986. What is that? That's your V plus. Calculate the approximate modified duration for the bond. What is the formula, guys? It's V minus V plus over 2 times your V naught or P naught. Let's keep it to V's times the change in yield. Okay, so let's plug everything in. Where's our V minus? It's up there. What was it? It's 110.765 minus our V plus, which is 106.986. Divided by 2 times our V naught was 108.541. What was our change in yields, guys? 50 basis points is equal to how many zeros? 0, 0, 5. Okay, guys, that should give you 3.779 divided by 10854. What did you guys get? Sure, so many C's. Well done, guys. Okay, the answer is C, 3.48, and it's like 1/6, but let's just round off. Okay, guys. Big red star. It's a lot of huffing and puffing, guys. Okay, so similar question to the one at the top. Okay, given a semi-annual coupon paying bond with a modified duration of 2.85, if required yields increase by 50 basis points, the expected price change is nearest to. Awesome, we can cancel out B because it's not a positive, guys. Okay, so what is the formula? It's the expected percentage change in price is equal to, what is it? Minus MD times change in yield. It's equal to minus 2.85 times how many zeros? 0.005, and that should give you minus 1.43%. Okay, another important one. A bond with a par value of 1,000, a 7.25% coupon paid semi-annually and 15 years to maturity is currently trading at 1050. So that's our V naught. If yields decrease by 50 basis points to the bond's price will increase to 1260. What is that? That's our V minus. And if the yields increase by 50 basis points, the price will decrease to 950. That's our V plus. The approximate modified duration is nearest to. So guys, okay, what is the formula? Exactly the same as above. V minus minus V plus over 2 times V naught times change in Y. Let's plug and play. So V minus, we got here, was 1260 minus the 950 over 2 times, what was our V naught? 1050 times 50 basis points, 0.005. Okay, what did you guys get? It's 310 over 10.5, which is equal to 29.52, which is A. Okay, question 6. A 9% 5-year annual pay corporate bond yielding 8% is priced at 103.993. Given an annual modified duration of 4.186, calculate the dollar duration of the bond. So what's the formula, guys? Dollar duration is equal to the change in yield times modified duration times P naught. Let's plug everything in. Guys, what was our change in yield? It went from 9% to 8%, which is minus 1%. Yeah, you can put your minus there. Okay, because then it's just going to cancel, so let's leave them out. 4.186 times, what was our P naught? 103.993. And guys, what does that give you? Did anyone get 4.353? Okay, quickly just plug it in, guys. It's super easy. Yes, A is correct. Okay, question 7. The market price of a callable bond is least likely to lie. Okay, guys, it's A. So remember this picture that I drew? Okay, here's your option-free bond. Okay, remember your callable bond goes like this. Okay, and your puttable bond goes like that. Okay, sorry, let's just put like this. So you can see that the callable bond will never ever lie above the price of a similar option-free bond. Guys, this picture is very important. Okay, because remember, if they say which bond offers negative convexity, and they give you callable, option-free, and puttable, what are you guys going to say? Callable, okay. Negative convexity, yes. Okay, or like which bond doesn't offer or isn't positive convexity. So guys, that's how this picture helps you. Yeah, exactly. Exactly. And remember, guys, duration is a straight line. Okay, question 8. Keeping that previous picture in your mind. At relatively high yield levels, as interest rates further increase, the value of a puttable bond will most likely. Okay, so remember, this is the picture. What's happening? It's decreasing. Sorry, my picture's not very good. At a decreasing rate. Okay, let me try to draw that a bit better. Okay, it's not happening, but you guys get my point. My drawings, it's really hard. This pen is a lot harder than you guys think. Okay, question 9. Which of the following statements about Macaulay duration is correct? So guys, now think about those other things that I told you. Remember about when maturity increases, duration increases. When coupon increases, duration will decrease. They inverse. So a bond's coupon rate and Macaulay duration are positively related. Is that right or wrong? Wrong. Okay, the bond's Macaulay duration is inversely related to its yield to maturity. Yes. The Macaulay duration of a zero coupon bond is less than its time to maturity. No, it is equal to. Okay, so guys, remember what I just wrote out for you. It's not in the solutions, it is, but like written out. But I just feel like that's easy to remember. Okay, and last question. You might not have seen this, but we're going to do it together. Consider a 5-year annual pay bond with a par value of 2.5 million. The bond has a modified duration of 4.25 and a full price of 102.55 per 100 of par. The money duration of the bond in terms of actual size of the position is closest to. Did anyone get an answer? C, when in doubt. Okay, so guys, money duration, when they want actual size, before you write the exam, if you like unsure, just pick one letter for the whole exam. Don't try and guess. Okay, so guys, it's the modified duration times the par value times the change in price. So it's your 102.55 over 100. So let's just plug it in. What was your duration? It was 4.25. What was our par value? 2.5 million. What's 102.55 over 100? It's 1.0255. Working all of that out, it should give you 10,895,937.5. Reading 55. So, in the occasion of bankruptcy, claims on the business at the same level of capital structure are paid in order of maturity from shortest to longest regardless of size. No. On an equal playing field, regardless of size, maturity, and outstanding. That's the right answer. Guys, they're on the same level of capital structure. That means everyone is equal. Okay, so paid on the first in and first out is wrong. Okay, question 2. You guys are going to get this one wrong too. It is possible that a subordinated bondholder may recuperate some value in the event of bankruptcy without a senior creditor getting paid in full when? Who said C? Well done. Okay, so guys, only when everyone agrees to some people, the subordinated recuperating, then they can get paid out. So only when everyone agrees to it. Well done, not everyone got it wrong. Okay, question 3. Consider the following statements. Have you guys heard of Porter's 5 forces? Okay, so this is what we're going to be thinking. Statement 1. Okay, generally speaking, cyclical industries entail greater credit risk than non-cyclical industries. Yes. Generally speaking, higher barriers to entry lower the credit risk of credit risk in the industry. Yes, well done, guys. Both statements are correct. Okay, guys, if anyone got this one wrong. S&P says it wants to slash credit ratings on South African government bonds. This is best labeled as an example of downgrade risk. Okay, we got downgraded last year. Okay, Spiro. Okay, consider the following statements. Okay, a bond rated BB or higher is an investment grade bond. It's higher than anything triple B. Okay, a bond rated CCC is a high yield bond. Yes. Okay, so the answer is B. Okay. Yeah, look at this. Okay, what are the other names for this? Junk, right? Okay, question 6. In the event of default, debentures claims will most likely rank exactly below the secured debt holders. Guys, what does debenture mean? Unsecured bonds. Okay, and if they're unsecured, obviously they're going to lie below the secured debt holders. Okay, question 7. A credit analyst is evaluating the creditworthiness of 3 companies: a construction company, a travel and tourism company, and a beverage company. Both construction and travel tourism companies are cyclical, whereas the beverage company is non-cyclical. Okay, the construction company has the highest debt level of the 3 companies. The highest credit risk is most likely exhibited by the, well done. Why? Because if they have high leverage, it increases their credit risk. Plus, it was highly cyclical, and therefore it's a volatile industry. Okay. Question 8. Loss severity is best described as the, C is the correct definition. Well done. Portion of the bond's value, including unpaid interest, and investor loses in the event of default. Okay, guys, for question 9, I drew this for you so that you'll never forget it. Okay, so let's look at the question. A senior unsecured credit instrument holds a higher priority of claims than one ranked as senior subordinated bond. Okay, so guys, mortgage debt lies as a super secured debt. This is where mortgage debt lies. And your second lien loan lies with your secured debt. So here's your second lien loan. Okay, and then your senior subordinated unsecured debt is there. Okay, do you guys want to quickly write this out? What are we thinking with question 10? B. Which industry characteristic most likely has a positive effect on a company's ability to service debt? Okay, guys, so if there's low barriers to entry, what does that mean? Anyone can come in. Okay, high number of suppliers to the industry. Guys, that means suppliers don't have bargaining power. Okay, so your company has bargaining power, therefore it's easier to service debt. Broadly dispersed market share among large number of companies in the industry, as well, that's going to decrease your customer. Okay, so A and C are wrong. Everyone happy?